You're watching the charts and you see it. A massive green candle blasts through a key resistance line. Your gut screams at you to buy, but the second you click execute, the price slams back down and turns violently red. That urge to jump in on a sudden spike without waiting for confirmation is pure FOMO, the fear of missing out. You see a fast-moving chart and your brain interprets it as an opportunity slipping away, triggering a dopamine rush that bypasses your actual strategy. Institutional players use these rapid surges to offload their own positions. As retail traders buy at the peak of the candle, they are providing the exit liquidity that big banks need to take their profits and leave the market. To survive in the Forex market, you have to stop relying on instinct. You need a reliable mathematical way to tell the difference between a sustainable directional move and a trap engineered to drain your account. The first step to identifying real breakouts is to stop using the words trend and momentum as if they mean the exact same thing. Think of a trend like the direction a car is driving. This chart shows a classic trend. It's grinding upwards over hours or days, but the pace is slow. It tells you where the price has been, regardless of how long it takes. Momentum, however, is how hard the foot presses the gas pedal. It is the immediate, explosive speed of the market right now. When extreme velocity meets heavy trading volume, you get a rare condition called the Momentum Volatility nexus. This is the exact point where rapid price swings are channeled into a specific, sustained direction. Locating this specific condition allows professional traders to capture explosive, statistically reliable moves, rather than guessing on erratic, low-volume market noise. Momentum does not happen in a vacuum. To sustain high-speed price action, the market requires massive amounts of fuel. And in Forex, that fuel is institutional liquidity. If you try to trade momentum breakouts during low-volume periods, like the late Tokyo session, you are going to get chopped up. There simply isn't enough money changing hands to push the price cleanly through resistance. The highest probability window for genuine momentum moves happens during the global overlap. Between 1300 and 1700 GMT, the major banks in London and New York are both at their desks. During this 4-hour window, you get the highest daily volume of transactions. Breakouts that occur here are rarely retail flukes. They are the result of massive institutional order flow moving the market. High-impact economic events, like major data releases from the Federal Reserve, act as the ultimate catalyst. But professionals know better than to gamble on the initial chaotic release. They wait for the second wave, when the volatility settles into a clear direction. Without confirmed institutional volume, a breakout lacks structural support. Attempting to ride momentum in a vacuum reduces the strategy to a gamble against market noise. To confirm that volume is actually present, you need a strict visual filter. We use a specific indicator stack to separate the fakeouts from true market velocity. Our primary gatekeeper is the Average Directional Index, or ADX. We look for a strict threshold. If the ADX reading is below 25, the market is ranging and we stay out. When it crosses above that 25 mark, we have mathematical confirmation that a trend is gaining genuine strength. At the exact same time, we check the MACD histogram. This measures momentum divergence. We want to see these bars growing taller. If the price is rising but the bars are shrinking, momentum is fading and the move is weak. But even with perfect indicators on your screen, there is a golden rule. Never, ever buy the initial breakout candle. Instead, we wait for a break and retest. This chart shows the price spiking through resistance, but then it pulls back down to touch the 20-period exponential moving average. This moving average acts as a dynamic trampoline. When the price touches the 20 EMA and prints a rejection wick, like a pin bar, and bounces sharply upward, that is your high probability entry signal. Utilizing this calculated pullback ensures you are aligning your entry with the actual trend, rather than providing the exit liquidity for the traders who bought in early. Entering the trade is only half the battle. The hidden danger of a high-velocity market is using static, fixed-pip stop losses. If the market is moving 100 pips an hour, a rigid 10-pip stop will inevitably be knocked out by normal market breathing. You have to measure current market volatility using the average true range, or ATR. This allows you to set dynamic stops, manually widening your stop-loss bracket to exactly 1.5 times the measured ATR. To compensate for that wider stop, you must shrink your total position size.
This ensures your overall monetary risk remains strictly locked at 1 to 2% of your account, giving the trade room to breathe without risking ruin. But how do you know when to take your money off the table? Eventually, even the strongest, highest-speed momentum run runs out of fuel. You look for the climax candle. This chart shows an established trend that abruptly ends with a single, massive final push, often 2 to 3 times larger than the previous candles. This represents the absolute peak of retail FOMO and the exact moment institutions are aggressively offloading their positions. Recognizing this sudden, disproportionate spike is your ultimate signal to tighten your trailing stops or exit the market entirely before the inevitable reversal crash. Professional momentum trading is 90% extreme patience and 10% clinical execution. You wait for the liquidity overlap, you wait for indicators to align, and you wait for the pullback. Stop chasing erratic market noise. By mastering these quantitative filters, you can start trading mathematically verified momentum on FXNX's institutional-grade platform.